In 1 year, shares of Credit Suisse have fallen by as much as 60%. Investors are worried about a 2008-style collapse, the last major financial crisis, when American banks had failed because of bad debt.
The bank's credit default swap price has jumped to its highest level, rising to 293 basis points. Credit Suisse is sitting on hundreds of millions of dollars in losses from leveraged buyout-related debt.
Now its executives are discussing reducing thousands of jobs globally.
This report raises significant concerns about Credit Suisse's compliance with the severe sanctions imposed by the United States and its allies and partners on the architects and enablers of Russia's brutal and unprovoked invasion of Ukraine.
Hi everybody, Credit Suisse is one of the biggest banks in the world. It is so huge that it generated a revenue of $22 billion, operates in over 50 countries, and its assets under management alone amount to $1.1 trillion. But in the past 1 year, something crazy has happened. They lost more than $14 billion in two terrible investments, have reported 5 quarters of loss in the past 7 quarters, and have laid off 5,000 employees. This, combined with the pandemic, the Russia-Ukraine war, and UK's economic turmoil, all of them have put this giant bank into a big risk. This situation is so critical that experts fear that it could lead to another nightmare like the 2008 recession. As a result, just like Lehman Brothers in 2008, its stock price fell by 60% in 2022 itself. So if this theory comes true and Credit Suisse goes bankrupt, just like 2008, it's going to cause one of the worst recessions of the 21st century. The question is, what exactly is wrong with Credit Suisse? Why are the investors comparing this and the 2008 Lehman Brothers crisis? And most importantly, what are the study materials to help you understand the impact of this economic mess better? To understand the Credit Suisse problem, we first have to understand something called CDS or Credit Default Swap. Now people, these words might sound very complex and very intimidating, but don't worry about it at all. I will explain it in such a way that even a 15-year-old will be able to understand this. So just stay with me and listen to this very carefully. Now, like we learned from the previous episodes, just like government issues bonds, there are even private companies that give out bonds. So let's say Adani Ports needs a capital of $1 million or $10 lakh. And because they have such an amazing brand value, they will float a bond and borrow money from common people like you and me. But one person cannot give Adani $1 million, right? So what would the Adanis do? They will break this $1 million bond into 10,000 units, whereby each unit will be worth $100. And over a 5-year period, the Adanis will pay back the investors a 3% interest. So when 10,000 people buy these $100 units, they're essentially lending the Adanis $100 each and $1 million collectively. And one of these investors is Nitya, who bought 1 unit of this bond for $100. So firstly, the Adanis would pay Nitya and other investors $3 at the end of every year, and after 5 years, they would return the principal amount of $100. This is how a bond works. Now listen to this very carefully. Let's say tomorrow there is news that UK and US both could experience a recession, and because of this panic in the market, now Nitya is scared that the Adanis won't be able to pay back her $100. Similarly, even other investors are scared. So this is where an insurance company comes in, which tells Nitya that they will insure this bond for her if she just pays a 2% fee of the bond unit. So if Nitya pays $2 to this insurance company, tomorrow, if the Adanis are not able to pay back $100 to Nitya, then the insurance company will pay Nitya $100. This is what you call as credit default swap, whereby an insurance company takes the risk on behalf of the investor, who's Nitya, if the borrower defaults. In this case, if Adani defaults. Now the question over here is, what is the benefit for the insurance company over here? Because after all, Nitya is just paying $2 and she's getting $100 in case of default. So how is this even profitable for the insurance company? Very simple. Just like Nitya, there'll be 15,000 investors who will buy a $2 insurance to insure their $100 units. So if 15,000 people buy the insurance, then the insurance company will have $30,000 in its account. And out of these 15,000 borrowers, the probability is that only 100 of them will lose their money. So the insurance company only has to pay $100 to these 100 people, as in just $10,000, which means they will still make a profit of $20,000. So just like our normal insurance, even here, the insurance company depends on probability to make profits. By the way, this insurance company could be any entity. It could be an insurance company, a bank, or even a hedge fund. If this is very clear to you, let's try to understand how did this credit default swap indicate the 2008 crisis.
The heightened financial turmoil that we have experienced of late may well lengthen the period of weak economic performance and further increase the risk to growth.
Here, a loss of 37 points or so. Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate.
There is no single action the federal government can take to end the financial market turmoil and the economic downturn.
So let's take you back to 2008 America. This is when there were a lot of people who were needing home loans and there were a lot of banks who were willing to lend money. So let's say there are 5 home buyers wanting a loan of $200,000 each. So the bank would lend a total of $1 million to these 5 home buyers at 6% interest. Now in addition to that, what the bank would do is, instead of giving out their own money, the bank will get $1 million from a rich investor named Rishi, and then they would distribute his $1 million into 5 parts as loans to home buyers. And in return, they would agree to give Rishi 3% interest. So you see what happened? The bank is charging a 6% interest to the home buyers, but is giving a 3% interest to Rishi. Therefore, the remaining 3% will be the bank's profit. This is what you call as mortgage-backed securities, whereby the bank takes a group of loans and sells them to an investor such that the investors get returns and the banks get profit without investing their own capital. So now, Rishi is happy that the bank is taking the risk of finding credit-worthy borrowers. The borrowers are happy because the bank is quickly disbursing loans. And the bank is happy because without using their own capital, they are still able to make a profit with 3% interest. Now pay attention to this. As more and more loans got disbursed, the bank executives got scared. So just like Nitya went to an insurance company, even these banks go to an insurance company. And just like Nitya got a $100 bond unit insured for $2, these banks will pay a 1% fee to get their $1 million loan units insured. So they would pay $10,000 as insurance for a $1 million loan unit or $1 million worth mortgage-backed security. So tomorrow, if these home buyers are not able to pay back these loans, the insurance company will have to pay the bank $1 million. This is what happened in 2008, and these insurance companies were none other than companies like American International Group, Bear Stearns, and the infamous Lehman brothers. So you see, in this model, even though the bank disbursed $1 million, it's taking no risk at all because they have their loans insured. And this is where, ladies and gentlemen, the problem began. Since these banks were able to get their loans insured for just 1% of the amount, they became extremely careless and kept on giving loans to every Tom, Dick, and Harry. In fact, after a certain point, these banks were giving out loans so easily that in 2007, a 22-year-old stripper was able to get a $2.4 million loan and bought 10 houses in just 90 days. And this is where something crazy happened. Soon enough, when too many homes got into the market, just like our China episode, there were more houses in the market than needed. And within some time, the cost started to go down, rents went down, and people started defaulting on the loans. And when this happened, the bank started facing a cash crunch. So what did the banks do? They went to the insurance companies to get paid for the defaulted loans. But this is where there was an even bigger problem. As it turns out, the insurance companies insured so much money that they themselves went bankrupt. As in, if 200 banks got $1 million worth of loans insured by paying a 1% fee, how much did the insurance company get in revenue? They got $10,000 from each bank and a total of $2 million. So they practically insured $200 million worth of loans, but had only $2 million as revenue. Which means, with this money that they had, they could only reimburse 2 banks for their $1 million of default. And they didn't have any money to pay the rest 198 banks whose customers did not pay back the loans. So in short, the probability got messed up. So now that the insurance companies didn't have any money, they had to start selling their own assets and start paying the banks. And if they could not, they went bankrupt. And this is exactly what happened to Lehman Brothers. They gave out so much insurance to banks and investors that they had accumulated $85 billion worth of portfolio, which was 4 times the value of its shareholders' equity. And since they could not pay back even after selling all their assets, they went bankrupt. And this is where, ladies and gentlemen, the chain reaction started. When Lehman Brothers went bankrupt, most of these banks who could not recover their money, they lost billions of dollars. The rich investors like Rishi did not get their money back, and some banks and investors even went bankrupt. And this is what led to a spiral effect, whereby the real estate companies could not get loans, and since nobody was buying houses, the construction companies could not pay their loans. And since these projects were unsold, these construction companies could not pay their suppliers, and those suppliers could not pay their suppliers who could not pay their bank installments. Eventually, people lost jobs, companies went bankrupt, and all of this snowballed into a catastrophe that caused one of the worst economic crises in human history, wiping out $2 trillion of investor wealth from the stock market. This is how the 2008 recession happened. Now the question over here is, why am I telling you the Lehman Brothers story, and how is this connected to the Credit Suisse story? Well, that is because one of the most important metrics that indicated this danger was this percentage fee that the Lehman Brothers were charging for the insurance. So when they were charging Nitya $2 to insure $100 worth of bonds, the percentage fee was 2%. And this is what you call as the credit default swap spread, or CDS spread. And the more this percentage, the more is the risk of insuring the credit. And this is measured in basis points, with 100 basis points making up 1%. So if I say the CDS spread is 200 basis points, it means the cost of insuring is 2%. Now, if you look at the Lehman Brothers CDS spread, you will see that after a certain point spiked and touched 250 basis points, as in 2.5% in March 2008. And immediately after that, we saw the US economy collapse. And the scariest fact is that now the CDS spread of Credit Suisse stood at 278 basis points, as in 2.78%. Which means what? Just like home buyers in 2008, several businesses and investors have taken loans from banks and have bought bonds. And these loans and bond units have been credit default swap, as in insured by Credit Suisse. So when this CDS spread is seen going up, it says that the risk of insurance has increased by a large extent. And just like the Lehman Brothers shares fell down to rock bottom with its increasing CDS spread, Credit Suisse has lost about 60% of its market cap in this year alone. Now, although this comparison is too dramatic, what we cannot ignore is that the Russia-Ukraine war has shattered the market, energy prices in UK have already shot up by 175%, the pound has depreciated by 21.4%, and the business in UK and Europe is already shrinking. So by the end of 2022, if the businesses who took loans from these banks start defaulting, these banks will have to go to the insurers, who in this case will be Credit Suisse and other big banks. And if they are not able to pay them back, it will again lead to a disaster just like the 2008 crisis. And why is this credit default swap so high specifically for Credit Suisse? Well, that is because apart from the pandemic, apart from the Russia-Ukraine related risks, apart from the currency fall, the bank already lost $9.3 billion and $5.5 billion by funding two companies called Greensill and Archegos that went bankrupt. As a result, out of the last 7 quarters, they have been profitable only twice. This is the reason why experts are comparing the Lehman Brothers with Credit Suisse, because both were considered to be too big to fail, both of them lent money to the borrowers, both insured dangerous amounts of assets, and while Lehman did not see a war, Credit Suisse got caught between a war, an energy crisis, a currency crisis, and even a pandemic. So does this mean Credit Suisse is heading for a crisis and a 2008 type situation is going to happen? Well, like I said, even the smartest people on the planet cannot predict a recession, which is why, as much as it is important to compare the past to the present and to keep a tab on the market, it's equally important to understand the nuances of the market. And this brings me to the last part of the episode, and that are the study materials to help you understand this critical moment in financial history. Meanwhile, if you're someone who wants to invest in safe stocks that remain relatively steady even during a crisis, you could invest into the all-weather small case. Small Case is this wonderful company that helps you invest in a basket of stocks to help you make smart investments in any market condition. In this case, they literally have a small case named the all-weather small case. And this small case will get you invested into those stocks that are less likely to be affected during adverse market conditions. And the best part is that the small case manager herself will rebalance the stocks based on the market conditions to give you the best possible returns. And even if you don't want to make any investments, you could read their blog posts and newsletter to get the latest and the most important market insights that very few people pay attention to. So if you want to make the most strategic investments in this volatile and chaotic market, download the small case app from the link in the description. Moving on, the first set of study materials that I'm attaching are the study materials to explain the concept of something called the Tier 1 capital ratio. Read through it and you will understand why Credit Suisse is still in a comfortable position as compared to the Lehman Brothers. Secondly, I am attaching all the sources to the concepts explained in this case study so that you can dig deeper and understand them better. And lastly, I am attaching a video from the Financial Times that will explain the bigger troubles that Credit Suisse has faced that could come and haunt it in 2022. So do have a look at them and let me know what you think. That's all from my side for today, guys. If you learned something valuable, please make sure to hit the like button so that YouTube algorithm knows that this video has given value to you. And for more such insightful business and political case studies, please subscribe to our channel. Thank you so much for watching. I will see you in the next one. Bye bye.